today on markets, we've certainly seen a bit of a rally today after what's been, the worst month for stocks in a decade. But this doesn't make a new trend, does it?
Well, what we've seen is probably a healthy correction in markets. And never forget, markets never always move in the same direction. The reality is when you strip away a lot of the day-to-day price movements, what drives markets is economic fundamentals. And when we look around the world, growth is good.
That's very positive. I mean, considering the EU just announced yesterday that actually growth is slowing down. We've had the same here in Switzerland. We've had warnings from the IMF, from the US as well.
So that's a correction as opposed to a reversal in growth. And if you think big picture what's happening, just as central banks around the world are tightening monetary policy, what we're seeing is governments around the world doing fiscal loosening. So they're easing policy, and really that's quite growth supportive.
But don't you think that we're at a bit of a crossroads, though, because we've had some good profits from companies. We've also had some pretty disastrous ones as well. But that will dwindle as well. We'll see more and more difficult times for individual companies because of this slowing down, because of this correction.
Well, perhaps, but that's where the government stimulus around the world comes in. And again, if you think of the list of governments around the world that are doing a stimulus, it seems to grow by the day. You've got the US, you've got France, you've got Spain, you've got Italy. In Brazil now, there's likely to be a stimulus as well.
But I don't agree with that because, hang on, we've just had the ECB announce that quantitative easing is going to end as planned. Nothing has changed. So they're not stimulating.
Well, that's the central bank piece. But, of course, when you think of the policy mix available to policymakers, on the one hand, you've got what central banks are doing. You've got, on the other hand, what governments are doing in terms of the spending or the fiscal side. So just as central banks are starting to step away, you've got governments around the world that are injecting more cash back into the system.
Let's break this down then. Explain to me what's happening in the United States currently.
Yeah, so when you look at the United States, the size of the deficit this year is likely to be 5%. So that is a gargantuan amount in peacetime. And what that means is that it's likely to be very supportive for growth. The other things, of course, that are very supportive for growth there have been the tax cuts.
But hang on, aren't the benefits of the tax cuts going to run out sometime soon, certainly in the next 18 months?
Of course, but in the scale of financial markets, 18 months is actually a fair time. And the real question of things like tax cuts and indeed a fiscal stimulus is, does it create growth that then becomes self-perpetuating? Do you get into a nice virtuous cycle? And who knows? We'll see.
And what kind of role does trade tariffs play into all of this? I mean, that can't be stimulating economy or on a global scale, perhaps at home for a time.
Yeah, no, so certainly what we're seeing around the world is less in the way of trade. But, of course, in certain areas, arguably, it can add a little bit to growth. If you get more production onshored back into various places, you can see maybe perhaps more investment in certain countries.
And just sticking with the United States for a second longer, when it comes to the US, do you think the Fed should hold off on that next rate hike as discussed? Or implement it as they promised?
Oh, they should absolutely be hiking rates in December. When you look at the Fed's mandate, which is unemployment, which is inflation, they're hitting both of those. And when you look at the trajectory of US economic growth, it is very powerful. That's a Fed that should be hiking rates in December and indeed well into next year.
And what about here in Europe? How will we continue to stimulate growth next year?
So partly it's back down to governments in terms of doing a fiscal stimulus. But you also get really the benefits of the growth we've already seen. So there's some quite powerful trends happening in Europe. We're seeing unemployment continue to fall, and we're seeing the early stages of wage growth coming through. Both of those things should be additive in terms of the growth picture.
What are you telling your investors right now?
So when we look at the fixed income world, we see a world with plenty of growth out there. So we want bonds that can do well, where you've got that backdrop of growth.
Do you have that?
Oh, absolutely. So if you think of things like high-yield bonds, a high-yield bond, your risk is the default rate. With a very low probability of recession, default rates should remain very low. So we like high-yield bonds, both in the United States and in Europe. We like bank bonds in Europe. When you think of the backdrop now, banks have done a very good job of deleveraging and raising equity in Europe. And the final area we like, a little bit controversial, emerging market debt.
OK.
And
why?
Well, when you think of emerging markets this year, they've had a pretty brutal year in terms of currency weakness, in terms of higher bond yields, and that's really a valuation argument. When we look at the valuation of a lot of emerging markets, actually they look fairly irresistible now.
You say emerging markets are quite controversial. You also mentioned bonds, and of course there's been a massive sell-off in bonds recently. A lot of fear surrounding Italy. You are confident that you're going to get some results there, but is there client appetite as well?
Oh, absolutely. I think the key with fixed income, and the clue is in the name, is the idea of income. And certainly when we chat to a lot of investors, there's still a great desire to generate an income. And fixed income's pretty good at that. And
have you changed your strategy at all with regard to this? Is this a new strategy for you, or is this just you continuing because you were incredibly confident in this strategy?
Yes, so when we look at it, we always change, and our portfolios tend to be fairly dynamic in nature. But the recent changes we've made have really been much more on the emerging market debt side, and that's where some of our portfolio additions have happened.